Imagine designing a system that removed every trace of human instinct from the market, an automated machine that followed logic instead of emotion, and then, just as it started producing massive results, choosing to drop your work on the table and walk out the door. To understand that decision, we have to look at the environment he was trying to escape. In 1970, the American financial system was a place of pure, unbridled noise. Trading floors were suffocating. Thousands of brokers packed shoulder to shoulder, screaming over ringing phones and passing physical slips to get an order filled. In this environment, millions of dollars changed hands based on a broker's gut feeling, a sudden wave of panic, or a whispered rumor. Human emotion was the primary engine of the market. But what if you could strip that human element out? What if a machine, completely indifferent to fear and greed, could be programmed to execute the trades instead? The person attempting this task was a 24-year-old outsider named Ed Seykota. Seykota didn't want to participate in the loud, chaotic casino of the 1970s. He wanted to replace the emotional way of trading with absolute mathematical logic. He was not a traditional finance broker. Seykota was an electrical engineering graduate from MIT. Growing up with oscilloscopes and old radios, he learned to view the world through waves, frequencies, and repeating patterns. To him, financial markets were just another type of signal. This perspective led him to the work of Richard Donchian, a mathematician who claimed that a purely mechanical set of rules could outperform human intuition. This chart shows how his strategy worked. Seykota utilized a concept called a moving average crossover. He tracked a fast moving average calculated over 5 days and overlaid it with a slower 20-day average line. The rule was strict. You buy the moment the fast line crosses above the slow line, and you sell the moment it crosses back below. The system ignored every external factor. It didn't read the morning paper or care about corporate earnings. It only followed the intersection of those two lines. But an idea only has value if it holds up under pressure. To prove his edge was real, Seykota had to test it against decades of historical market data. Today, you can run a 40-year backtest on a trading strategy in seconds using a smartphone. In 1970, the technological barriers were massive. Seykota had to run overnight access to IBM 360 mainframes, machines so large they occupied entire climate-controlled basements. He spent his nights reading printed stock prices from newspapers and manually punching them into these cards, translating paper records into physical holes in the paper. The margin for error was zero. If he made a single typo on one card, the entire stack would fail, and a full night of expensive computing time was lost. But through this repetition, the mainframes eventually printed out the results. The data verified his theory, proving he had built a successful computerized trading system for the futures market. By processing decades of data one punch card at a time, Seykota confirmed that his logic held up. He wasn't guessing on the trading floor. He was executing a calculated edge. A major brokerage house hired Seykota to implement his system for their clients. It worked exactly as designed, and the machine began generating massive profits. But the system soon ran into a variable the math couldn't fix: the ego of the people running the firm. The board of directors could not resist the urge to interfere. This chart shows the result of that interference. A predictable trend line violently distorts into a jagged path as the executives began tweaking the parameters and injecting their own gut feelings into the code. Seykota warned them that manual interference destroys the mathematical edge that makes the system work. If you override the signals, you no longer have a system. The executives refused to stop. Rather than watch his work be dismantled by ego, Seykota packed up his punch cards and left the corporate world behind. He moved to the shores of Lake Tahoe. There, far away from the shouting and the noise of Wall Street, he traded his own money, following his own rules in total isolation. Seykota demonstrated that building a mathematical system was only half the battle. The harder part was the discipline to step back and let the math work, even when every human instinct screamed to interfere. Over a 12-year run, a single trading account starting with just $5,000 was transformed into $15 million. The architect was Ed Seykota. He didn't trade from a hectic pit or bank of telephones. He operated from a quiet home office, utilizing early mainframe computers to analyze market data. At a time when Wall Street relied on gut instinct and emotional reactions to the daily news cycle, Seykota was building a system designed to strip human bias out of the equation entirely. The ultimate test of that system came in the late 1970s. The billionaire Hunt brothers began an audacious attempt to corner the global silver market. They used their vast wealth to buy up massive quantities of physical silver and futures contracts, effectively attempting to monopolize the world's supply. This chart shows the result, a vertical price spike. Silver moved from a baseline of $6 an ounce to an all-time peak of nearly $50 by January 1980. This rapid ascent drew in the public. Retail traders and speculators began selling assets to buy into silver, convinced that the momentum would never end. The collapse was just as vertical as the rise. Starting on March 27, 1980, the silver bubble burst, and prices plummeted over 70% in a matter of weeks. Fortunes were vaporized instantly. The Hunt brothers were forced into bankruptcy, and traders who bet their life savings on the trend were left with nothing. For those who traded based on headlines and public conviction, there was no safety net when the market sentiment finally shifted. While Wall Street was in a state of total panic, the atmosphere in Incline Village, Nevada was perfectly still. Ed Seykota had already exited the silver market. He didn't lose a penny in the crash. Instead, he walked away with a massive profit, having closed his positions a week before the peak. Seykota didn't need to predict the crash. His strategy worked because it was built to respond to price changes, rather than trying to anticipate the next piece of news. Seykota famously dismissed fundamental analysis as fundamentals. He believed that by the time a news story was written, its impact was already over. This diagram illustrates why. By the time the public hears a major news event, the price has usually already moved to reflect that information. The advantage is gone. Instead of news, Seykota followed the trend. He used price action as his sole guide, moving in and out of markets based on mathematical signals. This is a trailing stop, a core part of his system. It's a mathematical line that follows a rising price. When silver finally slowed down and dipped below this line, it triggered an automatic sell signal. This mechanical rule removed his portfolio from the market before the crash could touch him. While other traders were still reading the news, Seykota's computer had already moved him to the sidelines. This level of discipline requires a specific mindset. Seykota was so detached from the outcome of individual trades that he even wrote a bluegrass song about his rules, celebrating the act of cutting a loss. He called it the whipsaw song, named after the frustrating moments when a price breaks out briefly, triggers a price signal, and then immediately reverses. These whipsaws are the price of trend following. A trader might be wrong dozens of times in a row, taking small, controlled losses while waiting for a major move. The math only works if you have the stomach for it. You accept 20 small losses, those red bars on the left, in exchange for catching the one massive, sustained trend that pays for them all. To survive those losses, Seykota used one ironclad rule. He never risked more than 1% of his total capital on a single trade. By capping his risk, no single mistake could ever bankrupt him. It turned trading from an emotional gamble into a game of pure probability. The Hunt brothers attempted to move the market through sheer force of will and billions of dollars, and they lost it all. Seykota accepted that he couldn't control the market's direction. He only controlled his response to it. By managing his risk and following the trend, he turned a $5,000 account into a $15 million legacy. If Ed Seykota's trend-following rules were as simple as they appear, anyone could copy his math, apply it to a brokerage account, and get rich. But the statistical reality of the market is brutal. 95% of all retail traders consistently lose money. To find the source of these losses, Seykota turned away from the flickering charts and toward the psychology of the people watching them. A mathematically flawless wealth-building strategy remains useless as long as the human being executing it is quietly wired for self-destruction. This led Seykota to a controversial conclusion. As he put it, win or lose, everyone gets what they want out of the market. Some people seem to like to lose, so they win by losing money. For a struggling trader, that sounds like a direct insult. It suggests that a person would log into their account and consciously choose to destroy their own hard-earned savings. Our stated financial goals and our actual results often pull in opposite directions. Traditional economics assumes we are rational actors trying to maximize profit. Seykota realized we are primarily emotional creatures. Think of a trader's psychology like an iceberg. Above the surface is the conscious mind, broadcasting a clear, simple desire: I want to make money. But lurking beneath the water is a massive subconscious. Down here, the desires have nothing to do with consistent, boring profitability. This part of the brain craves excitement, the adrenaline rush of a massive gamble, the high of a win, and the drama of a devastating loss. For individuals starved of thrill, wiping out a trading account is the price of admission to an emotional roller coaster. Because the subconscious almost always wins, this hunger for drama forces traders to act against their own best interests. They sabotage safe setups and override their stop losses just to feel a rush. The market efficiently extracts wealth from anyone seeking emotional thrills over mathematical returns. To solve this, Seykota created a community process called the trading tribe. It was designed to bypass logic and directly confront these subconscious emotions. The tribe operated on the premise that the feelings we try to resist are the ones that control our actions. Suppressing panic about a trade eventually forces the hand into a terrible decision. Seykota taught that actively accepting and completely feeling a terrifying emotion allows it to lose its power. By leaning into fear, the emotion dissolves. Reaching a quiet, neutral emotional state is the prerequisite to following a system without interference. We often obsess over the software, the algorithms, and the price charts. But the real performance depends on the hardware, the human brain running the operation. Seykota realized his lines of computer code were not the secret to his success. He was the actual trading system. A mathematically perfect strategy will crash if it is installed on emotionally bug-ridden human hardware. Seykota built his legendary returns on a foundation of internal discipline, rather than outsmarting the system or predicting the next move. His acts came from accepting his complete powerlessness over market uncertainty and mastering the storm of his own reactions instead. He stopped trying to bend the market to his will and focused on simply riding the trend.